Yeah, okay. And I work with the U.S. Federation of Worker Cooperatives with the CoOp Clinic that does technical assistance for co-ops that are getting started, for folks that want to do education with their membership. And I did a session a few weeks ago about co-op development, and I'm excited to share some about CoOp Finances. And a lot of what I'll be sharing is pertinent to finances of nonprofits and social enterprises, but some of it is specific to co-ops. And I am happy to be interrupted at any point with questions, so jump in. I do have some slides, so if you can be in a place where you're looking at slides, that'd be great. And I do have an activity coming up soon. So if you have a product or service that might be of interest to work through cost of goods sold exercise, consider just being an example for that. So let's get started. Screen share. All right. So our goals today are to understand basic financials and cooperatives. And I'm using a lot of materials from the Co-op Fund in New England, who has done a lot of education around finances in New England, Cooperative Development Institute, and Boston Center for Community Ownership. Just have to give them a shout out. And we'll be going over financial statements. So number 1, 2, and 4 are really relevant to any social enterprise, small business. And number 3 will dive into something that's really unique to co-ops. That is a mechanism called internal capital accounts, and we'll be getting some visuals on that. And I'm mostly gearing this towards people who are interested in starting a co-op, but it's also useful if you're a board member of a nonprofit or of another organization that where your role is to look at financial statements. Hopefully this will be useful for you as well. So let's dive right in to one of the 3 main financial statements that you often see. The first one's called the balance sheet. And this one you can think of as a snapshot in time of the financial health of a business or organization. And the main thing you got to check for is, does it balance, first of all? You know, using this equation, assets equals liabilities plus equity, does it balance? So see 7,000 plus 2,000, 2,000 plus 2,150 plus 4,900 balances out to the 7,050. So that's the first thing to think about. But you also want to, there are a couple other equations that I'll be sharing with you where you can figure out, is this company in a good place in terms of how much debt they're taking on, or their current ratio, their current assets to liabilities. Is that a good ratio that's going on right now? And so you can see kind of the health of a company right with one statement. But again, this is a snapshot. This is one point in time. It's not a change over time. So this is a good overall report to be taking a peek at. And we'll be going into some more exercises on that, but feel free to jump in with any questions you have so far. This is the balance sheet. All right, another one you'll often see is the profit and loss, or it's often called the income statement. So if the balance sheet was a snapshot, if it was a photograph, this one's a video. It's over a period of time, you can see the change in revenues and expenses of a business. And sometimes it's called an income statement. And so here's a really basic way to do it, where you have your revenues and your expenses, right? And you just take your revenues and subtract your expenses, and you get your net income. There are sometimes 2-step ones where you see a gross profit. So you take all your revenue and then you take off the cost of goods sold and you get your net profit, and then you take your expenses and get your net income. This one, you want to take it could be any period of time. In this case, it's a quarter, right? A financial quarter. You can have it be a month, it can be a year. So profit and loss statements are really key to see how things are going in terms of income and expenses and balancing those. So that's the next big one you'll often see in terms of reports. Any questions so far? All right. The third one you'll see is a statement of cash flows. So your cash flows, if the balance sheet was a snapshot, a photograph, and the profit and loss was a video over time, statement of cash flows is another video over time, but with the point of view of cash. It follows the money, right? It says when things come in and when things go out, and how much is coming in. That's cash that's ready to go, liquid assets, and how much is tied up in other assets that are more tied up and not cash or cash equivalent. So this is another one, a really important one, sometimes an overlooked one, but an important one to keep an eye on, especially if your business is using accrual basis accounting, which is where the income and the expenses are recorded when they're earned or incurred, not when they actually hit the bank or exit the bank. So it's really important to check your cash flows, especially if you're using accrual, which is most common. So it shows how liquid, the liquidity of your co-op or business, and how much operating cash you have on hand. And then it can help you, even if you do a report of cash flows, a statement, it can help you project your cash flow, future cash flow. Because if you can't manage your cash in your co-op, it's going to be very hard to have a really successful. You're going to be running into issues of making payroll or paying your vendors. So accurate cash flow projections start with a good statement of cash flows, and then really realistic projections from that. So those are really key things. Those are the three main statements that you'll often see when you're taking a look at the finances of any organization or co-op or business. And we're going to be doing some exercises, but are there any questions before we jump into some activities?
I have a quick question. Yeah. Can you
Angel and Fiona? Yeah.
Yep. Can you explain like the difference between operating activities and investing, like really briefly? Because it seems like really for a co-op, operating activities is the real where the meat is, especially of what you're saying. But then what's the difference when it's under investing?
Sorry, I'm not sure I got that full question. What the operating expenses are compared to, what was the question?
Yeah, operating activities, like what would be tracked under operating activities in terms of cash flow,
Oh, that's most of your activities. Anything that's going on under the business that's not investment. So that's your sales, income would be there under the net income. If you have accounts payables that are going up or down, you track them there. If you have accounts receivables, which is money that's owed to you, you'll track those there. So all of those kind of transactions are your operating activities. The only thing that's not under there is your investing activities. So if you have made purchases, so things that show up on your balance sheet go under investing activities. If you've purchased equipment, if you've made investments, if people have invested in you, those kind of things go under investing activities. And financing activities, if you've taken on debt or if you've paid off debt, those go there. But everything that has to do with sales or your accounts payable and receivable, that goes under your operating activities. Does that answer your question? All right. Fiona, you had a question?
I was just curious if if it's typical to do this monthly, the statement of cash flows, it's not a larger period of time, right? Because we need to, I think the idea is to be on top of your cash flow status, right?
Yeah, monthly is the most common.
Okay.
Some groups do it weekly, to see their weekly cash flow.
Sure.
It's common to have cash flow statements that show month to month or week to week and have a whole bunch of, months lined up. So you see, patterns and things like that. But you're right, you want smaller periods of time compared to the other statements for your cash flow. Yeah.
Okay. And I think just real quickly, going back to Angel's question, so the investing activities, I mean, would we necessarily, is that just to kind of bucket up some potential risk of not having enough cash? Or I guess I'm just, is it always going to be like a negative number? And so it's kind of trying to help you see your risk for your cash flow projected issues?
Not necessarily. Your
Okay.
investing activities could be investment into your co-op. It could be sale of equipment.
Okay.
It could show depreciation of your equipment. Things like that could be not negative numbers. So yeah, this is just like a really oversimplified one here for this example purposes.
Thank you.
Yeah. All right, so I have a question for you all. Anyone feel free to chime in. What is wrong with this balance sheet?
Uh-oh.
What looks
it
off?
doesn't balance.
Oh.
Right. Exactly. When you add up your liabilities and your equity, it doesn't meet your assets. So it's an imbalanced sheet. So all right, let's fix that. Here we go. We have a corrected one, and I have another exercise. So these are the two tests that you can use to taking a balance sheet and doing some tests to see the health of a co-op. You can get the current ratio. This is just, can the co-op pay its bills? Do we have enough liquid assets? How are things going in the current moment? So you take the current assets and you divide it by the current liabilities, and you forget about the equity for now. So this one,
it's still not balanced though.
This balance sheet is balanced, I think, because it's
you have
your
17,000
liabilities.
And you have 19,000
oh, you're right,
in
it's
assets.
still not balanced.
It's still not balanced.
Good point. It's still not balanced. It's imbalanced. Good catch. Well,
that was another test.
Let's still take, yeah. No, that was an error. But let's still use this, and it should be fine to be running these equations for now to just get a sense of how things are at right now with this co-op. So let's see. We take our current ratio. Where are we at generally calculating our current ratio? About what?
4-to-1.
Yeah.
Yeah, it's about 3.8. So usually your current ratio, if it's 1.2 to 2, it's in a good spot. If it's under that, you got to be careful. Maybe you're not going to be able to make your expenses. What do you think it means that it's so high in this case for this co-op? Why is it not recommended to be so high on our current ratio? Any thoughts?
Are we losing opportunity somewhere?
Right. Are we not investing our assets very wisely? Right. Yeah. Maybe we could be investing them more into some other aspect of our business. Right. Exactly. So 3.8 is pretty high. Maybe we need to take a look at that. Maybe we can afford to do some more investment in the company. Great. So then let's look at the debt to equity ratio. And this is something that anyone who's investing in you will be looking at closely. And, you know, they're checking basically, are you over leveraged? You know, do you have too much debt on your books? If you had to, you know, liquidate your company and pay off your debts, would you be owing a lot more than you actually have? So this is the liabilities divided by equity. So where are we at generally with this in this company?
Less than 50%, it looks like.
Yeah.
A little under 50%. So we're 0.42. So does anyone have an idea whether this is a good debt to equity ratio or not so good?
That's good.
This is a strong, this is a strong place to be in. If you're under 2, in most circumstances, you're doing pretty well. The most common is between 1 and 2. But in this pajama co-op, we're doing pretty well. So we've got plenty of wiggle room there with our liabilities, and we have quite a bit of equity built up. It must be a pretty good industry to be in. Any questions with these tests or
What was
these ratios that we can?
what was the current ratio you said was kind of a good range?
1.2 to 2 is generally accepted. It depends what industry you're in and where you're at in terms of a newer business versus more established, but 1.2 to 2 is the generally accepted good range to be in.
Thank you.
I have a question for you in regards to the lines in this. So capital equity, is that the amount that the owners invested in the company? How does that work?
That's usually, in a co-op, it's mostly the members investing that capital, correct. Or building up that capital in the internal capital accounts, the next line down. But in co-ops, you can also receive outside equity investments. And those then don't show up as immediate liabilities. They show up as equity in that capital arena. So those are like a loan to you would show up in your liability, right? But an equity investment in your cooperative where they're pinning their stakes on their returns on you doing well shows up in your equity. And it's usually better for the health of your business and your balance sheet when you get those kind of equity investments. Does that answer your question?
I think so. So it's it could be external investors who invest into the co-op, and those monies go into the capital equity line.
Yeah, but it's usually mostly the membership or investment from the members of the co-op in a cooperative. That's generally the bulk of your capital.
And if I might just add to just my understanding here, if there were some returns to those capital investors, would that come out of the accounts payable liabilities? Like if they got some dividends or something?
Right, if there's a fixed dividend and they're not paid out yet, like they're owed it, but it's not paid out, it could show up on your liabilities, correct?
Got it.
Yeah. All right, so we've figured out how this co-op is doing, and we understand this test, and we can use it against another balance sheet that's put in front of us. And then I'm going to next go into more the looking forward, the projected financials. This is when you're putting together your business plan to get financing or to get investors or partners. And they're going to really look at your pro forma, which is basically a projected financial statement. And you're going to have to make a lot of assumptions, but but those folks, the lenders, investors, partners, they will scrutinize your assumptions. So make sure when you make these projections that you have them backed up by real research. That could be surveys of what customers would pay, or something that backs up your projected sales, right? Asking other co-ops what they've spent realistically to get a good sense of what your expenses will be. So if you're getting ready to start a co-op, then it takes quite a bit of research to figure out what your projected financials or your pro forma statements will be. And you often want to do it to the extent where you find a break-even analysis, it's called, where you can see how many sales will you need to be able to break even, and then you can project a little bit more than that in year 2 or 3, for example. And it's common that your pro forma, especially in startups that are starting from scratch, to project some losses in your first year, 2, or even 3. But it's important to see some, surplus generated by year 3 or 4 usually is what they'll be looking for. And really, at least you being able to meet your expenses. So have a real good sense of your startup costs. That's your initial investment that you're going to need to be making. The financing that will be required. So that's equity financing and debt financing, the 2 things I just explained. And then really getting a good sense of your cost of goods sold, which we'll be doing an activity in a second about. And then the other 2 statements. So you basically take the 3 statements we just talked about and project it forward 2, 3, 4, 5 years, depending on what industry you're in. 3 years often suffices. Some require more, like 5 years. So that's generally what a pro forma is and how you go about doing it. Here are some tools to set up your pro forma, so you can start with some templates and fill in the data for your co-op. And we're going to be going over an exercise. But let me share different screens. Any questions so far on pro formas? Okay, so one tool for a pro forma, a template that you can use, the Democracy at Work Institute, which is linked to the U.S. Federation of Worker Co-ops. It's kind of the think and do tank linked to the Federation, came up with this template. And it's a good one, especially for service or retail, but mostly for retail kind of cooperatives. And you can download the Excel file, and it has nice templates for you to work on. So take a peek at that link if that's of use. And then Boston Center for Community Ownership and Worcester Roots came up with this other one that's good for services especially. So for example, I'm a worker owner of a future-focused media co-op that does media production. We do PSAs, public service announcements, for example. So this was one example that we used to figure out how much we should charge and how many per year we need to sell to break even. So we took a look at a 4-hour, so PSA, maybe it takes us 4 hours to make, right? And an expensive PSA out there might be $300. On the low end for this kind of PSA might be $150. We thought maybe we could sell, because a lot of our clientele are grassroots organizations, so maybe $200. And then we look at the inputs that we need and the hourly wage, and we come up with how much it costs us to make that PSA. But instead of going through this example, I would like to take an example from one of you, any product or service you're thinking of providing, or if you already are part of some sort of entrepreneurial project that you want to work through this. Please chime in and tell us what your product or service is. It could be a pair of pajamas to a dog walking service, anything. Anyone want to workshop their product or service and understand cost of goods?
If no one else will, I can offer, a bookkeeping service scenario, maybe. I don't know if
Okay.
it's so
What's
professional
one-
services.
Yeah, that'll work. What's one kind of tightly knit component of your bookkeeping that you could offer, like one review?
Yep.
Or what's one product that's, yeah.
Yeah, so I would say monthly bookkeeping for, business that's gross revenue of, $50,000 a year or something like that.
Okay, we'll call it 1 month of bookkeeping just to keep it a compact thing.
Okay.
For under what?
You could just say small business. How about?
For small business.
Yeah.
Okay. What do the really expensive bookkeeping outfits charge for 1 month of bookkeeping for a small business, you'd say?
Probably upwards to like $1,200 a month is my guess.
Mm-hmm. And the really cheapo outfits, what would they charge?
It could be as low as maybe 100. Varies a lot.
Okay.
Yeah.
And then, so where in that range do you think, knowing your potential clients or your clients,
Yep.
what would you feel comfortable billing?
Yeah. So actually, maybe I can tighten up. You said a more succinct product line, so product offering. So maybe it's 1 month of minimal. How about medium transactions? So medium transactions, that is quantified. That's kind of how I think they price things. So, it's like 100 transactions with 3 accounts or something like that. So we can just call it medium transactions. So then the high range for something like that might be a little lower. I'm guessing maybe about 700. And the low range is probably still okay, actually. And so you're asking what I would charge?
Yeah,
Okay.
just for these purposes. We're not going to hold you to it.
Okay. I would say probably about 400.
Okay, and we'll come back to that probably later. So are there any costs of goods? Do you need to print out? So this is where we look at cost of good versus overhead, right? So your overhead are things like your rent or, equipment or anything that is done across multiple products or services. And your cost of goods are things that are directly linked to that service that you're providing, right?
Sure.
So what are things that might be linked to that? And it could be printer, ink, or, anything.
So I could say we would print invoices and mail them. And so it'd be printing, postage, I guess things like that. And
okay. And
mm-hmm.
do you want to estimate in the 1 month?
Per client.
How many of those? Yeah.
Yeah, let's say, for like a plumber, maybe it would be 30 of those at like, what is the cost of a stamp? I don't know, 60 cents. So let's say 70 cents at 30.
And let's add a little more for ink and paper and stuff.
Right.
We'll just do,
yep.
Oops, not $80, 80 cents.
There's
so
also
about $24 and
There's also pass through for a QuickBooks account. So, they would just I would invoice them and they would pay it. So that would be $25 a month, I think.
Okay. Any other costs directly related to this service you're offering? So if
Yeah,
you're
there's
if
so
you're doing
few.
a physical if you're doing
Wouldn't
a physical
payroll be
product,
there?
it's usually more, right?
Would you include the
Sorry,
cost of the worker there? Or an
It's
estimated cost there, or is that separate?
Hmm.
labor's right below. We'll get to that in 1 second.
Okay,
Good thinking.
gotcha.
Yeah, that's definitely.
Yeah, so let's make
But-
believe we print out like say they hire me to this is for that item. As part of their service package for the monthly service, I provide a mid-year and end-of-year financial statements, and I mail it to them. I mean, we're really limited on the goods part here. Sorry.
Yeah. No, this is good. So,
Okay.
and let's say that price is $2 or something, right?
Yeah. Yeah.
For that financial statement.
And that's twice a year.
And so here, right, so monthly would be, what's that?
It'd be six
Be
to,
1/6.
yeah, 1/6, something like that.
So 33 cents. I really that's some. No,
What a
but
deal.
If your product is like a pizza, then you're going to have a lot of cost of goods sold, right? Because you'll need to buy a lot of mozzarella, dough, all that kind of thing, right? And you'll see your margin later is lower, but maybe your overhead is not as high. So your overhead, again, you might, compared to a bookkeeping co-op that needs to do all its marketing and things like that, you might have more overhead, so you need to have lower cost of goods sold. So but here we go. Most of it is in the labor, right? So we don't have to say what you actually take home for hourly wage, but let's just put a number in here for these purposes. This is the take home before any benefits on top.
Sure.
What should we
So
put here for some
if it
sort
were
of
me
bookkeeper?
or if I hired someone, I think it would probably be around $40 an hour. For this,
$40 and
an hour?
okay, and is that $40 an hour, right? So
It's worth
about
becoming
how
a
many
bookkeeper,
hours?
guys.
Yeah.
Yeah.
And is that as an employee or as a contractor?
I would say as an employee.
So then as an employee, you're going to want to add some labor burden, right? That's minimum is 15 just for taxes and Medicare, Social Security and stuff. But most companies will have more labor burden than that. Union jobs are often in the 40 to 50 range. So what percent labor burden for bookkeeping?
Does that include benefits like employer contribution to their medical, dental, and stuff? I don't really know.
That's all included.
I guess estimate,
so,
I don't know, 30%?
That's probably a good guess because 15 again just covers your direct expenses, your FICA and all that. So then if there's some other benefits, including healthcare, then it's probably up around 30. So then your hourly burden rate is 52. And then how many hours will it take to do that service?
Yeah, probably for that employee, it could take 3 hours a month, maybe.
3 hours a month. So
yeah.
If you could do 3 of these in 1 hour, you'd put 3 here. But but you're doing 1 of these for 3 hours, so you're doing 1/3, right? Do you see how that works?
Yep.
So you're actually spending 156 on labor for those 3 hours that you're spending on this service. So your cost per unit is 205. So let's say you said you're charging 400 and your cost per unit is 205. So your gross profit for that product is 194, and your margin is 48. Now, your margin, if you don't have a lot of overhead, you're not paying anyone for marketing, you don't have any rent or equipment or things like that, then this could be pretty low, right? You could get most of what you're generating goes towards your labor, and maybe the few, the printer ink and stuff. But if you have a lot of those other expenses and a lot of overhead, you want to make sure that your margin is pretty large, or that you're selling lots and lots of these to cover, right? So checking out that margin, do you want to go back and revisit your 400, or are you comfortable with that?
So what you're saying is that margin is near 50%, and say I have very little overhead, and so you're asking, would the cost of the service, would I want to adjust it? And if I did, would I want to adjust it lower, right? To bring down the gross.
Yeah, well.
Is that what you're saying?
Or could you adjust it higher too? And yeah, I guess if you're thinking you don't have a lot of overhead, the other thing to consider is how many sales you're making. We only have 5 clients, and we need to have some good margin with those 5 clients. So that's another consideration when you set your price. This is just the beginning of the tool for your performer, right? To figure out, and you could do this for every different product you have, So like for our video co-op, we had the PSA, and then we have an 80-hour to make wedding video, right? So it could be for each product, you could have a very different cost of goods sold calculation done. So I think we have to get back to other things, but are there any burning questions about our cost of good versus overhead expenses?
By the way, the margins aren't really that good, so I probably screwed up some numbers there. Yeah.
You probably spend more than 3 hours on that client, just guessing, but yeah. Let's just see what an overhead expenses thing could look like. This is all the bank fees and any donations you make, depreciation you want to keep track of, financing expenses if you're paying your loans, your marketing expenses, your meals and entertainment. That's always so high in co-ops. Our office expenses, of course, are here. Professional lawyer fees, accountants, those are all overhead. This is stuff that you have to pay no matter how many services you sell or goods you sell. You're going to need to have these overhead expenses. So it's important to keep those separate as you're doing your financial projections. Any other burning questions about cost of goods and overhead stuff? All right, let's get back to, oops. So these again are the links to Performas. Are you able to see these Performa links now? So again, the service one that we just did is at the Worcester Roots website there. That's a good one for services. And if you have more of a retail kind of business, the DAWI one is really good, the institute.coop one. So here we're going to get into some co-op specific stuff. So profit is the net income that's generated by non-members. You don't just talk about profit as all net income in cooperatives. It's a very specific definition. Because a lot of co-ops have members and non-members. In worker co-ops, you might have a lot of your workers being members, but some of your workers are on membership track or they're not wanting to be members right now. So anything that's generated by them, you just calculate how many hours they worked. You take a percentage of your net income, and that's called profit. And we'll get into why it's important to separate that from what we call surplus, which is your net income that's generated by your members. So all the hours that members work in a worker co-op is surplus. Because we need to calculate patronage, right? How much the member has participated in the co-op. In a worker co-op, it's usually by hours worked. In a consumer co-op, it's how much you've purchased, right? If you're a member of a food consumer co-op, for example, you're earning patronage every time you purchase from that food co-op. And at the end of the year, if your co-op does patronage dividends, they give you some money back. It's based on how much you've purchased. But if you work in a worker co-op, it's how much you've worked in that co-op that you're accumulating as patronage. It's basically your use of the co-op. If it's a marketing cooperative or producer co-op, it's how much you've produced. And then when we talk about individual capital accounts, this is the co-op's equity that's allocated to an individual, to a member, but it's kept as a working capital. And this is a great thing that co-ops offer, worker co-ops especially, offer this opportunity to not be taxed twice, but to be able to hold some of the capital that you've created as working capital in your co-op, but have it be a wealth generating mechanism for your members. They can be accumulating this capital in the co-op, and it can be paid out when the co-op is ready to pay it out. So it's a great option, and we're going to go into how that actually works through the co-op. But these are some terms to understand. So first of all, you take the net profit from the year, right, generated, and again, we look at what was generated by non-members, and we call that profit, and that's taxed at the corporate level. And then you look at what was generated by members, and you call that surplus, and that you have another choice. Once you see how much surplus you have, you can choose, usually the board of directors, it could be all the members. If you have a collective co-op, then all the members make a decision, usually annually, how to distribute your surplus. How much you're going to put into your collective allocation, into your collective account, and again, that's taxed at the corporate level, and how much goes into patronage dividends, which gets paid out to the individual. So this is an important decision that you often set in your bylaws, like we're going to be doing 60-40 when we can, or the board can decide. You set that going forward, and then depending on how the company is doing and how much you need to reinvest, you can make those distributions. But then when let's go look at the member patronage, blue circle on the left there, you have another choice. You've allocated it to individuals, but you want to say, give some out in cash that people can take home there at the end of the year to at least cover their taxes, right? So you want to do at least 20% so they cover their taxes. But then you can put some in the individual capital account, the little piggy bank, with a mechanism called written notices of allocation. And this is getting kind of complicated, but I just want to show you, like, this mechanism is a great way to keep your money in the co-op, but have it allocated to individuals so that all the members are gaining and they're building wealth in the company, but you have this mechanism to keep it in the company and to build equity and to show it as equity on your balance sheet, and it can really help, and you're only taxed once on it. But those, if they're going into the piggy bank or they're going out as cash, those are taxed at the individual level. And it depends what kind of co-op you are, what rate that is. But so each year you kind of build up, as the piggy bank is there on the bottom left. Each year you build up your individual capital account, and then it's paid down when the co-op can pay it down, or when you leave, you have that, within the co-op will say within a year or two, we'll pay you back for your capital account. So this is a lot. So let me pause here and see if there are any questions or people wanting to try to restate it in their own words or anything like that. Feel free to chime in.
I think there's one question. What is the name of the type of professional that helps structure this sort of thing?
Yeah, you don't need to know how this works to a T. You just need to know that it's available to co-op, and you find an accountant. You need to know an accountant will help set it up. A bookkeeper can help you keep track of it, and we'll be going over that. But you'll want to find an accountant that understands co-ops or is willing to understand co-ops. And at that at the U.S. Federation's site, usworker.coop, there's a directory there of accountants that understand co-ops, and you can look up which one you like and check out their website. And usually you can just hire them to set up your account so that it's working like this, and then maybe once a year to help you file your returns, and to maybe work with your bookkeeper to make sure everything's in line. These capital accounts are not in QuickBooks usually. There is a way to do it, but it's a little messy. Most co-ops do it in a separate spreadsheet and just refer to it or bring it in as a lump sum, annually or however makes sense for your co-op. But yeah, good point. You don't need to know all the details of this, but get an accountant that can help you set it up right, or so you can really take advantage of this subchapter T, so you're not paying double taxes, and you can keep this investment going in your co-op. Any other questions or thoughts on this? I think I'm close to time, so let me just run through the last few things, which is good bookkeeping practices. If you're getting your co-op up and running, get a good bookkeeper. Sounds like you might have some locally, but here are a few that really get co-ops and are co-ops themselves. WorcesterBookkeeping.coop is one in Worcester. That's women-owned and really gets cooperatives and is a worker co-op themselves. Bookkeeping.coop is the website of Bookkeeping Co-op, ABC, and they're really good. They have folks all over, I think definitely New York City. And then Common Good Bookkeeping is another one. I think they're based in Madison, Wisconsin, maybe, but these days you can share virtual files. And then if you work directly with Stacy at Boston Center for Community Ownership, sometimes they offer some bookkeeping services too. So here are some ideas of people who can offer bookkeeping, or you can work with someone like this to train an in-house person too. That a lot of these folks are willing to do that kind of work. And then other good best practices are to keep good records, keep your receipts, to keep a really good check register, or do everything in your computer so that it's there and it's not lost in the ethers. And keep up with it too. So you set up good systems, but keep up with them and follow them, monthly, and set up good budgets and then monitor your budgets. Don't just set and forget on your budgets. And then really be aware of, what you need to do for the IRS and your state tax and employment regulations. And if you don't know this stuff, make sure you have a bookkeeper that can help you keep track of this stuff. Make sure you're sending out your 1099s to your contractors if they've worked over 600. All those kind of things, you got to really keep on top of that, because what took down Al Capone in the end? It wasn't any of the murders. It was the IRS. So keep an eye on that stuff. And finally, it's important to have trust in your co-op and with your bookkeeper and your accountant, but it's important to also have verifications and safeguards in place, right? So this could be 2 signatures on your checks, regular monitoring or checking of the work. And in co-ops, we're really all about transparency, right? Having financial transparency to your members especially, and to your investors and folks like that. And one tool that's really spelled out and you can look online is open book management. So those are some things to keep an eye on. And here are some upcoming things for the Co-op Clinic and the U.S. Federation of Worker Co-ops. There's an online conference. It's free, September 10th and 11th. There are some awesome movement speakers for that. So check it out at usworker.coop. And there's a monthly startup webinar that the Federation does. And the next one's on September 4th. So thank you all, and I'm happy to answer more questions, or however, if you need to move into working groups, I'll pass it back to facilitators.
Hey y'all. Thank you so much. That was really, really helpful, Matt. Super helpful. I know, is any of the burning questions? I know we're a little over time, but I definitely want to give space if there's like something that folks really, really wanted to get answered by Matt. Great. Yeah, thank you so much, Matt. And so we're at a point where we're going to move into our member teams. Today is Investor Outreach and Anchor Institute, Anchor Institution. So I guess we'll pivot over to that. Who's here for Investor Outreach? Oh, and I'll stop the recording, by the way.
Thanks, Matt.